for ANZ's CVC arm out of Australia.
Hi everyone, I'm Phil Vidler, Managing Partner with the FinTech Growth Fund.
Hi, I'm Stephanie Heller. I'm the Managing Partner and Founder of Bootstrap Europe. We're a venture lender.
Terrific, thank you. So the title for this afternoon, although we won't, perhaps we'll navigate it as our conversation develops, but was VC investors can take a long-term view through the turbulence of the last few years. And then, so that's the negative. There's also a positive we'll get to. What sectors are they seeing as the most innovative and exciting to back in the coming years ahead? But I don't think we can talk about where we're going without talking about how we got here. And I'd love to get the perspective of the panel, just a little bit about, of say, 2015 and beyond, that last few years of the up and to the right. Alokik, do you want to start with us?
Sure. So given we're the last session, I think, or second last session, we thought we'll keep this sort of moving. If you think about the last cycle and where we've got to, say 2015 through to 21, we were in this complete hype cycle of venture, interest rates were still zero, plenty of cash flooding the market, all kinds of ideas were good ideas, everything was up and to the right, and growth at all costs. And I think that was encouraging and interesting. It was fantastic for people looking to come out to new ideas, potentially get them funded and drive forward. But at the same time, you also had plenty of excesses. Excesses spending, excesses on marketing, not a lot of focus on customer acquisition costs, or what's that going to mean over a long time, as well as the realities of sort of where are we going to go with this? What's going to happen as the world may turn? What's going to happen as you have different funding environments? What might happen as you've got more difficult sales cycles, or routes to exit, or opportunities to return capital? So all of these things were things that we didn't have in front of us at the time, and sort of built this business sort of flood. And I think every version of every idea got funded, not just 1, 2, 3, 4 of them, maybe 15 of them. And we all know, being in venture for a little bit, all of them cannot be successful. You have natural attrition at different stages, at different series of funding. So that's kind of some of the stuff we saw in front of us. Capital was fast, capital was cheap, high valuations, limited governance, all those wonderful things that you could see.
But during that period, when it came to value add, there was a lot of competition, right? 15 term sheets for every round. And what was the opportunity set that you were presenting? And maybe we go further down the panel. Nicole, being a CVC, what would you present to your prospective investee companies?
We have it extra hard in that we source globally, but as a strategic investor, our LP is an institution. Not only do they provide us a chunk of capital, we are structured as an LP GP structure, I have to point out, but we have to find strategic fit. So that's tough enough, but we could be sourcing globally and having to find strategic fit for a company that needs to leapfrog into Asia Pac, right, via Australia. So we've had a particularly, we've nuanced that. What we've done is, first of all, we have 3 funds, right? So we essentially positioned ourselves to be able to go the entire funding life cycle, from seed through to M&A, I have to say. Not to say that there haven't been lessons learned, and we definitely know we can't be all things to all people or founders. But besides the hype cycle, I think what we found worked is, we have to bring not only a market to our founders, that's the main attraction, but we have pools of resource that we have had to activate within essentially our LP structure. So that is some of the kind of the toolkit we bring to life, and we can work really hard to kind of make sure that we sit in that founder journey for as long as we can. And that has proven valuable, although obviously the last few years have been pretty tough, and I don't think there's any of us that haven't, suffered along with our portfolio to some degree. But we're very well placed now. We're very confident about 2024 and beyond. I'm not going to jump to the rest of the panel piece, but...
Phil, do you have a view on what you see?
Yeah, I mean, I think we're in a slightly different position. Having only launched kind of end of last year, we kind of came in at the point of the hype cycle finishing, and then everyone kind of desperate for cash, so it was a slightly different market when we were going into. But I think your points there around, what you were trying to add value from at that short term, and a lot of VCs necessarily didn't. They just provided the cash that Alokik was talking about. The challenge is now the same when we're moving forward about what we're growing for firms. So FinTech growth funds, similar to you both actually, from a strategic perspective, a lot of our LPs are in strategic institutions. We spend a lot of time with those institutions trying to understand what problems they're facing and how we might be able to find technological solutions that we can help invest in and hopefully help scale across those. So again, that's a big part of our arsenal as well, as working with the likes of you others and others, and making sure that we really do build that value add moving forward, rather than just the kind of capital demand that was always going to be there, especially now.
So taking advantage of a turbulent market might be a theme that we could talk about. Of course, we're very positive here. Roughly, I guess 13 months ago, 12 months ago, there was a little bit of turbulence in the debt markets with SVB going down. Bootstrap Europe has acquired a big portion of that. How has that evolved over the last, say, 12 months for you?
Yeah, it's a very good question. So obviously, it's a difficult market for the VCs. It's hard for them to continue to raise on their existing funds. So you see the liquidity in the market going down, and obviously the debt market has had ups and downs as well at the same time, which also reduces the amount of capital for the startup ecosystem. So obviously, from our perspective, when you're a lender, you have to be extremely patient. You have to think that you can't pull the trigger on the business. You have to continue to support the business over time. So we continue to support the ecosystem. Taking over the SVB assets in Germany was part of it. It was about really saving that group of borrowers in that specific geography, but also this is a portfolio that has performed quite well. It's very surprising, maybe, to think that non-cash flow generative businesses continue to repay, but they do. The reason for this is because the best companies continue to raise capital. Also, maybe the rounds are not as high and valuation are, adjusted. And what happened in our portfolio really is that some VCs get disappointed by the valuation that they're getting in the market, and so maybe they want to add or prolong the runway of those businesses by adding more debt or by restructuring the debt. So we've done a lot of that, being supportive to the ecosystem.
So just on that, 12 months ago, I think our prediction, at Orrick would have been that we would have had a flood more of venture debt. We didn't feel that much. Is that what you saw? Or?
It's correct, because it's a very conservative way of lending. And I think a lot of the lenders didn't feel comfortable with the runway that some of the businesses had. So I think so we're a function of the VCs. We work hand in hand with them. So when they do not invest, we won't invest as much, right? So I think this is what you've seen.
Yeah, and for any of the founders in the room, hopefully most of you are all of that universe. Have you seen the VCs not dipping into their pockets over the last 12 months?
Well, sometimes they do give up companies, in which case when you're a lender, you need to be supportive to the entrepreneurs behind. Obviously here we have a very different panel. We have panels of strategic investors, they're CVCs, so maybe they don't need to raise the additional LP money. So there is a bit of a nuance here. But when they can't raise for the existing fund, where they can't continue to support the companies that they don't regard as the fund returner, then you need to step in because we can't afford a loss. So we work then hand in hand with entrepreneurs to make sure that they work. So a great company that we have in our portfolio is a mortgage company, it's a FinTech company named Habito, and Ying, who's the entrepreneur that was brought in to take over, managed to turn a profit in 3 months after taking over. The reality is a lot of the businesses, as you mentioned, had problems with their CAC, their customer acquisition. They had issues managing their own costs, and there was a need for a restructure of these businesses. And I think it was possible to turn a profit out of those large burns.
I think
right?
Stephanie makes a great point there, which I think is also there's no question it's been a tough 18 months, 2 years, wherever we are. But what we're left with is actually much healthier companies at the end of it. Don't get me wrong, it's been painful, and for founders, going through that journey, it's not an enjoyable one. But coming at it from an investor perspective, and also, if you can look at it from a founder perspective, you're left with businesses that have had to streamline, they've had to refocus, and actually are probably in a much healthier place to now grow, have a backbone of where their profitability is going to come from. And as a result, now looking at a fresh market, probably what you were talking about, not to drag us into the positive too early in the topic, but I think what it does mean is looking forward, we've got some really exciting assets there now that we can support, and founders that are much better prepared to cope with problems should they face them moving forward.
I mean, it's really interesting on those points, right? So there's a few different observations. So one is, if you take, there was an interesting stat that I think Morgan Stanley put out recently, that 50% of all unicorns are going to need to fundraise before the end of the year. Okay, well, that's interesting. There's fundraise and there's fundraise. So what does it mean to say, are you going to take a mark down based on your reality? Are you going to put in structure? Are you going to do liquidation preferences and other things? And this comes back to founders, where sometimes it's not only the founders who have to make that call, but their existing investors who are out fundraising are protecting some of their track record, right? Because they need to go out and raise money, which is, again, it's the cycle of how this industry works, which is really important. But I feel like often the founders get caught between some of that. And the best thing for founders in some of those cases where it's taking longer to deliver value, or you might need to reset your valuation, is important, because you want to continue to incentivize your teams with the right equity, the right ESOPs, the right options. And so you want that to be at the right price. Giving someone options that are wildly out of the money is completely pointless, right? So they're not going to feel any incentive. They're going to jump across the road and go join your competitor or somebody else. So I feel like it's those kinds of things that we're going to have to work through with reality over the next 6 or 9 months, to really get a healthy ecosystem, as Phil is saying, and be cognizant of what it's going to take. Be real about your budgets. Be real about how long your sales pipelines are. We're part of strategics. We know what's happening there. There's prioritization. There's resource constraints. There's budget constraints. There were 100 projects that were running before. Now maybe there's 50, right? And so, but that's a reality that's going to need to be sort of taken into account when you're looking at your own pipelines and budgets. Is that deal really going to close in 6 months? No, it may take 12. Okay, let's plan for that, right? I think that's really important.
Yeah, and I think the macro lens is also really interesting. I'm surprised when capital allocators are not really focused on the macro environment. We've heard a little bit about it this couple of days, but I think certainly in Europe and the UK specifically, we have such an opportunity with the new regulation coming through for alternative investment funds, the LTIF and ALTIF regulation in the EU, which is, we've heard about the Mansion House Compact. That is, on the prima facie, fresh capital coming into private markets, which I'm surprised the traditional players in this market haven't got their head around. Is that an opportunity for VCs, or is that a threat, right? So we're keeping a very close eye on what that means for founders, and how can we wrap ourselves around that and activate that and educate our founders in Europe or in the UK on that opportunity for capital access.
Just to jump out, I think it's an opportunity for VCs, but it's probably an opportunity that's not going to move anywhere near quick as everyone was hoping. Mansion House Compact was a brilliant first step, and institutions are starting to move in that place. But the reality is that's a long time. And you go to an institution that's not been investing in private assets before and go, right, you're going to launch an LTAF, you're going to have to hire a private markets team, you have to start looking at this. This is a 3, 4, 5 year journey rather than money flooding into fundraisers and GPs right now. So I think it's definitely a good thing for the industry, but I don't think it's going to be a 2024 solution. It might be a 2028 solution, and hopefully that is. But it's great that we're moving there, but I don't think it's a golden bridge flooding at the moment.
It's also bringing an access point for different kind of capital, right? The UK ecosystem has been really fortunate because we've had EIS and SEIS benefits, funds, structures to bring initial capital into some of these companies, which has been great. And I think this allows a different degree of access through the pension fund routes, but also at sort of chunks that can be digestible within an average sort of retail audience. I think that's what it does best. Right? We're an investor in a platform called Moonfair that allows smaller chunks of capital to come in from mass affluent investors into venture funds and private equity. This takes it even a degree smaller to allow that capital to come in. So.
Well, if we look at the comparable Macron did some pretty amazing things in Paris, and 5 years or so later, we have an absolutely fantastic ecosystem in Paris. A huge number of amazing companies, repeat founders moving home, and arguably the #1 AI company coming out in the world, coming out of Paris and Mistral. So, I would encourage us to be doing this and more and more.
Oh, 100%. It's definitely a positive thing, don't get me wrong. It's just, what we shouldn't be assuming is it's an instant fix. This is part of the fact that we need to continue doing these things because we want a sector that's going to be building for the next 10, 20, 30, 40 years. So not every solution has to be a solution for right now. But it's about building a sustainable long-term ecosystem.
It's about repeat entrepreneurs, really.
Exactly.
Right? Because the crisis that we've seen and the difficulties that the founders have gone through, this skill set of going through tough time is something that you can't replicate, right? When you're just a first-time founder. And I think the coaching that can come from entrepreneurs that have sold their business, the coaching that at the board level that can come from experienced investors that have gone through tough times and so on. This is what the ecosystem needs, and we are there. We're there already.
We are getting there, and that's what we've lacked, right? We've had a vast body of VCs that weren't founders, and that's a very big delta between here and the US. We've had a lot of investment professionals that haven't actually had that journey, and so it's hard to pass that advice when you haven't done it yourselves.
Sorry to just interject on that, but I think this is just another talent issue, right? We always talk about talent alongside funding being one of the biggest issues that we have in FinTech generally, but also the UK standpoint. It's not just, coders, it's also experienced board level people to be able to support those founders and coming through. I think the plus side is the fact that London and the UK is still a big attraction for that talent at that point, and it's easy to bring in. You see most of the bigger fintechs with US advisors sitting on there that have been there and done that. So it's not necessarily that they have to be grown here. It's about, can we import the talent we need to support these businesses moving forward? I think that is where we're in a reasonably good place, but always can do more.
I think the talent point is so interesting, right? And you're absolutely right, Phil. It's like the talent of all types, and it's the experience of all types that we need, right? So you need repeat entrepreneurs, you need repeat investors, you need repeat board members, you need people who've all sort of done it before, because that's the only time you sort of get a bit of pattern recognition of what might work, what might not work, etc. And you're absolutely right. Many people in the industry haven't had the experience of doing any of it before. And that's stuff that, yes, we're not going to change overnight, and we have some more work to do, but I think it's getting better. I also think having a mix of folks around you to help advise, whether it's your board or other things for founders, is really important. You need to have a mix of people. There's no point having a board of you and 4 investors. You're not going to get much diverse opinion there or any views around it. All your investors will want that, or in the last hype cycle, nobody wanted that because they were very happy to write checks with no governance. So I think it's kind of interesting that now, and I'd say over the last 18 months, what me and our team have been doing is literally spending time with our founders where we have board seats. Where can we help? What's going wrong? What do we need to do? How do we need to think about this? And in every shape and form, rolling up your sleeves and trying to help. That's kind of what the job is about. Whereas for a whole host of people, like you were saying, Shawn, an entire early generation of investors, it was kind of, connectivity and writing checks, right? Having drinks and writing checks, which was easier to do through an easy market cycle, and it's much harder to do now. So I think we just have to be realistic about what our business is, which is that writing the check is easy. It's getting it back that's more fun.
One of the lessons we learned is, and we've learned many, right, is we, as a strategic, we delayed, we analyzed way too long. So, we came into the cycles just too late. We sat in kind of no man's land on the cap table for some of really important portfolio companies, and we were too late to help support or even rescue when they needed help because we didn't have the visibility. Those are huge lessons for us. So we've, I think capital allocators, whether they, in venture or anywhere else, are learning those lessons too. So definitely motivate for balance on your cap table.
Well, we often say that some of the best companies are started in times like this, but what I think you're saying as well, and I completely agree, is some of the best investors learn through this process as well. So with 4 minutes left and 4 bright minds on the panel, what are you most excited about in the FinTech space, of course, because we're here today, for the future? Stephanie?
Well, I can start. You know, for us, and especially in the FinTech ecosystem, we're quite excited of the new, business models that are being generated right now. Obviously, technology is advancing at a very high pace right now, and we believe that a lot of the startups need a diversified source of capital. So obviously, equity, but the debt product can be a very fascinating way of financing part of the operations that should not be financed by something as expensive as equity. We're looking at, there is some new regulation on digital assets in the US that's coming up, and I think it's going to give birth to opportunities for us to lend against stronger collateral in, the crypto space or things like, well, we'll see, but, there is big progress happening there. Maybe some part of, let's say, the regulatory reserve that you have, shouldn't be financed necessarily with equity. So we think that the debt has a big role to play in the FinTech ecosystem.
I mean, for us, we're a growth investor, so a little bit cheating in the sense of what was really excited for us this year to come is probably what was really hot for the seed investors last year and the early stage investors last year. Also, we joke when we talk around this, AI is going to be huge, it's going to be exciting, but also we're still faxing orders in certain parts of the industry. So there's a hell of a lot of money to be made and a lot of exciting businesses that are working with the institutions to revolutionize the way that we do finance. And I think there's a massive opportunity still there that we continue to be untapped. And it's where also I think those true growth businesses sit alongside some of the new technologies coming through.
So we're excited about financial infrastructure. As excited as you can get. FinCrime, so financial crime, specifically, I think we're looking at the subsegment of financial crime, so scams, and particularly how we attach ourselves to actually solving that. Does AI provide both deepfake threat or a solution? The automation of compliance, another very exciting topic we're very excited about. But we're also very interested in under the kind of banner of financial well-being, how we capture this for all the good reasons we know, this kind of renter economy, and bring that into the potential for ownership. This is a big challenge, and so we are fixated on how we help people own more things.
Cool.
I'll agree with a lot of the things here, but maybe I'll add a couple more. So I think given we center around the worlds of wealth and asset management, we're thinking about some of the AI models that are going to be applicable, take Gen AI or even AGI, that's going to be applicable across those sectors into the forward that may be applicable across what happens when the rates come down, what happens when your macro environment changes, what happens when you're coming out of recession in different countries and different economies. So some of those pieces. And on the infrastructure side, we're interested in things around transition finance. We're interested in things on digital asset institutionalization, private market infrastructure. So lots of the different nuts and bolts underneath it, and some of the things that may be a little bit further afield as well, but plenty to be excited about in the forward. As we said, we're coming out of a time when some of the best companies should be born now. Investors are going to have probably very good vintages coming out of this cycle. That could be really exciting for many years to come. So no, we've been exciting, we've been busy, we've probably done 4 investments at the beginning of the year, so plenty more to come.
Terrific. Well, with that, I think we've just hit the buzzer. So thank you, and please join me in thanking our panel.
Okay, you can't see from where you are, but I've changed into comfortable.